Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. This video is going to focus on the S&P 500. I'll cover the ASX 200 and European stocks in a separate video, and I'll leave a link for that in the description section below. I'm also going to show you a fascinating graph that shows just how extremely oversold this market is, so make sure you stick around for that. As always, this is general commentary and doesn't take your personal situation into account. With all that said, let's get into our first chart. So we've got the S&P 500 up on the screen, and look, as you know, it's been another ugly week. It's been another ugly week for the S&P 500 and global equities generally. The S&P 500, well, it's continued to sell off since breaking down below support at 3,900 last week. It also briefly traded at a new low, so breaking below this low over here in June. So quite simply, the technical structure of this market remains weak, and we've got a market that's sliced through a support zone, and it's now sitting on its lows, and it's also below declining moving averages. So I'm using the 50 and the 100-day moving averages. So make no mistake, this is a vulnerable market, and I think that it really does warrant extreme caution at this current point. So let's go over to our 4-hourly chart for a moment, just get a little bit more detail on the last week's price action. And so we did see a reaction. So when we, so here's the low, there's the June low. So the market did break below that June low, and then we got a reaction last week. And that reaction coincided with the Bank of England announcing that it was going to be supporting the bond market, coming in and buying bonds. So that gave global equities a bit of a bid tone, and we got a bit of a rally. And that raised the question about whether there was going to be other central bank pivots, like the Bank of England, like where they'd set the lead, and then the Fed was going to pivot, and other central banks would pivot. So it put a briefly more positive tone into global equities, but that doesn't seem to have lasted too long, with the market retracing all of those gains. At this point, I've got to say the overall technical structure, it remains weak. That's not to say that that we can't get a double bottom forming. So we'll go back over to a daily chart for a moment. So it's not to say that it's completely out of the question that we get a double bottom form around current levels. But you know, like, the thing to remember is, like, there's nothing certain in these markets. So whilst this is a bearish looking chart, the setup doesn't necessarily have to lead to an ongoing decline or even a crash. There are other scenarios that could lead to an unlikely but a sizable rally. So a crash or a sell-off, they're just possibilities. I think they're possibilities that we need to be prepared for with the market in this current state of vulnerability. I think this is the way the market currently is set up. I think it's got the potential to be really be a pivotal moment. I think what's likely to happen over the next few days is that we probably do see a retest of this low from Wednesday. So the market's most likely, I think, to test that low. And if that happens, then it's a case, well, what happens? What happens then? So is it going to be a case the market breaks and then continues to sell off and gather momentum on the downside? Or do we get a completely different scenario? And this is a possibility I've seen quite a bit over the years with markets, in that maybe we get a test of this low from Wednesday. Then maybe there's no more this selling. Maybe there's no follow through selling. And when that sort of event happens, the market will then usually quickly rebound above the breakdown point. It starts to trigger short covering, and then that opens the potential for that to lead to further gains. So that's not a prediction that that's going to happen by any means, but it's one of those possibilities that we always need to keep in mind. Look, I don't know which way this is going to go. I don't know whether it's going to be the that more positive scenario or a continuation of the current bearish decline. But what I do know is that this is a time for caution. Yes, sentiment is about as bad and as bearish as you ever see it get. And yes, stocks are very oversold. Let me just show you how oversold they are. So this is showing the number of S&P 500 stocks below their 200-day moving average. And this blue band is showing you from when it gets down to around 15% or fewer stocks above their 200-day moving average. So you can see where we are now. There's about 11% of stocks that are above their 200-day moving average. And that's about as low as it gets. This goes back to 2007. This is a weekly graph. And barring this period during the GFC, usually doesn't stay down here for too long. It's usually a touch and us away. So look, you don't know with these oversold indicators because the market can always get more oversold. So this doesn't mean that the low is imminent by any means, but we do know that we're in the territory where a low can form. So it's about keeping an open mind that different things can happen. Going back to our daily chart, like an oversold market, we've got an oversold market, excessive bearish sentiment, and these are normally things that we'd look for when we were considering, are we going to see a low? Is a low going to be formed? They're factors that we look for. But despite those factors, it still remains a vulnerable setup. We just don't have the price action at the moment. The price action at the moment doesn't give us I don't think it puts us in a position to put a reasonable probability on a bullish scenario. I know people like to call the low, but I think that's just full of risk with how the market is currently set up. And let me just say this, the big money is made by identifying trends and then staying with them. It's not by trying to pinpoint the low. People are trying to pinpoint lows all the way down. People are pinpointing lows. They often get run over. So it's not about pinpointing the low, it's about identifying the emerging trends and running with them. So while this does have some of the makings of a potential low, we just don't have confirmation from the price action. I think this is poised in a way that really could go either way. And we just need to be cautious, stand back and let us see how the market plays this current setup. And if you're getting value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. It just tells YouTube that people are engaging with it. People are watching, then YouTube's more inclined to show other people. And it takes ages to put these videos together. So if you can please do that, it really does make it worthwhile. I make them so people can watch them. And it's all about getting them out there so people can find them and people can watch them. And hopefully it helps them. And also come and visit me at motiontrader.com.au. See the other stuff that I'm doing over there that never know, may be able to help with what you're doing. Now, I think the first step in breaking this current sell cycle would be a break above resistance breaking back above this resistance at 3,900. And we can also put some Fibonacci retracements on for this last decline. And you can see they all come in. They all seem to cluster around this 3,900. So I think that's quite a key marker if we're looking for potential turning points. We could have a case where the market rallies 5% from here. We could have a case where the market rallies back to 3,800, then turns lower again and then makes new lows and continues to decline. I don't think this market's out of the woods at least until we can get back above this resistance band. It's quite feasible that we see a decent, you could see a 4 or 5% rally. And people think, oh, look, that looks like the market's starting to rebound. But unless we can get through that resistance, it could still easily roll over. So that's why the caution is so necessary. I think it's now a case of let's just wait and see where the market goes from here. Jumping the gun, trying to buy early, I think it just carries too much risk in my view. And if you're buying into a market when it's at a vulnerable point, you greatly increase your risk of losing capital. So I think now's the time to protect your financial and your mental capital, because your mental capital is just as important, because opportunities will emerge at some point. And the people who are going to be best able to capture them are the ones who are mentally and financial still in good shape. And we want to be ready to take those opportunities when they appear. So I think for now, let's wait for the price action to tell us. Wait for the price action to tell us when the risk reward is in our favor. That's when we want to play. We don't need to play at the moment. Wait until probability and the reward justifies getting involved. So hopefully that helps. Thank you for joining me. Look forward to coming back, talking to you next week. Until then, bye for now.